All right, so welcome to the first Forex coaching webinar of the year. It's 2019. A happy new year to all of you. And I'm Adam Koo. And in this Forex coaching webinar, we'll be going through how do we identify high probability bounce and TCE setups, trend continuation entry setups. And as a bonus, I've actually asked some of our fellow students who have been trading for a while to share their own experience about what has been working for them and to give their own tips to those newbie traders who have just joined us. So if you've just joined us, welcome to the community. And for those of you who have been trading with me for the last couple of years, it's really been an honor, it's been a privilege, it's been a lot of fun trading together with you every single day. So I'm going to begin by doing a quick review on the rules so we get on the same page. And I'm going to begin with the bounce strategy. So again, the bounce and the TCE are very similar. And they both have pros and cons. And I know some of you like to trade the bounce exclusively. Some of you like to trade the TCE. Some of you like to trade both. And I wouldn't say that one is better than the other one. They both have their own pros and cons. And fine, you can trade both strategies or you can focus on one. Is entirely up to you. So let's begin with the bounce strategy first. So for the bounce setup, let's look at both long and short. First, about going long. So what are the rules? So again, let's clarify the rules. So when we're going long, we want to see a clear uptrend. So a clear uptrend means the price must be above the 18 EMA, and the 18 is above the 50, 50 above the 200. So all the moving averages are in sequence, and you want to ensure that the 50 EMA has been tested at least once to be a strong support. So this strategy is we buy when the price bounces off the 50 EMA. And how do we know that the 50 EMA is strong? We want to see that it's been tested very recently. So for example, on this chart graphic, you can see, first of all, we must have the proper wave pattern where we must see that this most recent swing high is higher than the previous swing high. And the most recent swing low where we're going to buy is higher than the previous swing low. So it is critical you have to see higher highs and higher lows. That's a must. So right now, as it's coming down towards the 50, we're going to buy as it hits the 50 moving average. But again, we have to ensure that recently the 50 moving average has been tested to be a strong support. So we want to see the price having gone to the 50 and bouncing off the 50 very recently. So if you're trading this on M15 on the 15-minute time frame, then check the higher level time frame for alignment. So if you trade on the 50-minute time frame, then you have to look at the H1 time frame to ensure that the H1 time frame is also on an uptrend, which means you've got the same sequence: price above 18, 18 above 50, 50 above 200. And like I mentioned, you must have the uptrend wave pattern of higher highs and higher lows. Now, ideally, if the 50 moving average support coincides with a horizontal support level or Fibonacci level, that would be a bonus. So 0.5 is not a must to have. It's a good to have, but it's not a must. So if you have that, that's just a bonus. Where you find that A to B to C, this happens to be a Fibonacci level, either the 50% or the 61% Fibonacci level. Again, it is not a criteria that's essential. So there are times I'll take bounce setups even if it is not a Fibonacci level. Okay, so how do we enter the bounce setup? There are two ways to enter. The first way to enter is a bit more aggressive, which means I'm watching the price coming down and I'm waiting for it to hit the 50 moving average. The moment it hits the 50 moving average, I will buy immediately. So what I do is, in anticipation, I will put a buy limit order at the 50 moving average, right at the moving average. So it's a buy limit order. So the moment the price hits, it will fill my order. So that is one way to do it, using a buy limit order. The second way to do it is wait for the price to come down and hit the moving average and let it pierce through it, right? Let it go through it by, just by a bit is fine. And the moment it goes below that, you then place a buy stop order. So instead of a buy limit order, so recall buy limit order means you buy at this price or lower. A buy stop order means you buy at this price or higher. So in the second scenario, once the price breaks below the moving average, we place a buy stop order. So if the price continues going down, what happens? Our order is not triggered. But if the price pierces the 50 and bounces back up, it will trigger the order and we get filled. So I prefer the second method, which is wait for it to pierce the 50, place a buy stop order. When it bounces back, it will fill me. Now, it really depends. On some days, if I'm very busy and I don't have time to watch it because I'm in a meeting or I'm doing something else, I'll just put a buy limit order. And I'll just pray that when it hits the 50 moving average and it buys, it will bounce up and not go all the way down, which it does sometimes. But if I have got time to watch it because I'm free, then I will wait for it to pierce the 50, and only then would I place my buy stop order and let it fill me if it bounces back up. Okay, so there are two ways to do that. It's up to your preference, and again, how much time you have to watch it. Now, the next question people always ask would be, okay, so you're buying here, for example, right? You're buying this level. Where do you put the stop loss? Where do you put the stop loss? That's a good question, right? Now, where I put a stop loss depends on, in a way, my profit target. So what I do is, I'm buying here and I'm looking at the recent swing high, which is over here. Okay, so I would usually measure the distance. So for example, if the distance here is 20 pips, for example, right? So where do you think I'll put my stop loss? I'll put my stop loss at 20 divided by 2. That's right, I'll put my stop loss at 10 pips. There you go. There we go. All right, why? Because when I'm buying here, I would ideally like to take profit at the recent swing high. I use the word ideally because, of course, sometimes after the bounce, it could go above the recent swing high and you could take profit over that. Right? You could. But it is always the safest if you could take profit at the recent swing high. Because sometimes it may hit the recent swing high and come back down again, and it forms a double top resistance. Okay? So if you can get your 2-hour profit by the recent swing high, that's a great trade to take. So the way I think is, okay, if I'm aiming for 20 pips as my target price, I can afford to put my stop loss at 10 pips. That's right, because I'm aiming for 1 is to 2. Got it? All right, so now at the same time, if I measure and I find that, hey, from the 50 moving average to the recent swing high is 30 pips, for example. Where do you think I'll put my stop loss? That's right, divide by 2, I'll put my stop loss at 15 pips. So however much profit I think I can take, I'll divide it by 2 and place my stop loss by that amount below the moving average. Does that make sense? Right. But whatever it is, the stop loss has to be at least 8 pips. At least minimum 8 pips for 15-minute time frames. Later, I'll talk about trading on the H1 time frame, where I'll use an even wider stop. For the M15 time frame, at least 8 pips. So in other words, if you measure from the 50 to the recent swing high, and let's imagine this is 10 pips, for example. Right, that's 10 pips. So where would my stop loss be? It would be divide by 2, 5 pips. right? So in this case, I will not take the trade. I will not take it. Why? Because 5 pips is less than 8 pips. So I find that there's not enough meat for me to capture to the recent swing high. And these are trades that I will not take. Next thing is to ensure, of course, before you enter a trade, check Forex Factory to make sure there's no major red news release within the next 10 candles or the next 2 hours, so that you can hit your target price before the news is released. All right, so now let's go for the bounce short setups. And again, right now I'm referring to trading on the M15, the 15-minute time frame. So for short is the opposite, right? We want a clear downtrend. So the Forex pair is on a downtrend, price below 18, 18 below 50, 50 below 200, right? And you want to see that downtrend wave pattern, which is essential, which means you want to see lower highs and lower lows. You got to see that sequence. So you are aiming to short here, to sell over there as it bounces off the 50. So the previous swing high must be higher than this current swing high. And the recent swing low must be lower than the previous swing low. So that's a must. So again, as the price goes up, you're looking to short once it hits the 50 moving average. So again, how are you convinced that this is a strong resistance? Well, you must see that recently the 50 moving average was tested to be a strong resistance as well. So again, 50 MA must have been tested at least once to be a strong resistance. Again, if you're trading on M15 time frame, always check one time frame higher, check the H1 time frame, ensure that it's also on a clear downtrend. Moving averages are in a downtrend sequence. Again, if the 50 moving average resistance coincides with a horizontal support level or Fibonacci level, that's a bonus, but it's not a must. All right. So again, let's look at our entry rules. So in this case, the price is going up and you're anticipating it's going to hit the 50 and it's going to bounce back down. So you're looking to enter here by selling. So again, there are two ways to do it. The first way is, like I said, if I don't have time to watch it, I'll just place a sell limit order at the 50 moving average. So my sell limit order is there. So the moment it hits my sell limit order or higher, it will fill the order. And again, I'm hoping that once it fills the order, it goes up slightly and goes all the way down. All right. So this is a more aggressive way to trade it. If I've got time to watch it, what I'll do is, again, I'll wait for the price to hit the 50, pierce above the 50. Then I'll place, instead of a sell limit order, I'll use a sell stop order. So again, recall, sell stop order means you sell, you'll be triggered only if it comes back down. So if I put my sell stop order and it continues going up, and I'll not get filled. But if it goes up, comes back down, triggers my sell order, I'm in the trade, and you go all the way down. So again, there are two ways to do that. So where do I place my stop loss again? Similarly for longs, what I'll do is I'll measure from the entry price to the recent swing low. Why? Because I ideally like to take profit right at the recent swing low or right above that. So if I measure, I've got, again, 30 pips of meat to capture, right? So I can take 30 pips of profit potentially. Where do you think I'll put my stop loss? That's right, divide by 2. So my stop loss will be at 15 pips. There you go. Okay. If I measure from the entry to the recent swing low, it's 20 pips. Where's my stop loss? That's right, it's 10 pips. Okay. Again, your stop loss should be at least 8 pips or more for the 50-minute time frame. Okay. Again, no major news release within the next 10 candles. So that's a quick revision of the bounce long and the bounce short setups on M15 timeframe candles. All right, so let's take a look at a recent trade and how you would measure the stop loss and target price, right? So at a point of time, when you're looking at a trade, you'd see something like this as it's going up, right? So you're anticipating that it's going to hit the 50 moving average, so you're watching it. And again, when it hits the 50, you're going to enter right there. So again, double check that the previous swing high is higher than this recent swing high. And the previous swing low is higher than this recent swing low. So you've got to have that lower high and lower low. All right. Now at the same time, you could also check if it's a Fibonacci level. So you click on A, drag to B. All right. So A to B is your impulsive wave. A to B is the impulsive wave, and C would be the retracement wave. So you can see over here it's a bit small, but it's 50%. So the moving average coincides with the 50% retracement, which again is a good to have. It's not a must, but it's a nice to have. Gives us extra confidence, right? Just okay. So the next question would be again, how do we enter this trade? So again, if you're more aggressive, you could actually put a sell limit order right there to wait. So the moment the price goes up, it will trigger your order. But again, the risk of that is that if it doesn't bounce down, it could trigger your sell order and go all the way up, and you may stop out immediately. So that's the risk of that, of course, right? So if you want to be a bit more conservative, wait for the price to go up above the 50 and place your sell stop at the 50. So if it comes back down, you'll trigger your sell stop. All right. So the next question would be, okay, so where are you going to put your stop loss? So again, I'll measure from the moving average here. If I'm gonna sell there all the way, hold on, all the way back down, so I'm gonna have my target price right at the recent swing low. So in this case, you can see it's 349. So 349, ignore the last digit, so it's 34, so it's basically 35 pips, right? So this entire distance, 35 pips. You may say, okay, let's be a bit conservative. Let's aim for maybe 30 pips, which is somewhere there. So if my profit target is 30 pips, where can my stop loss be? 15 pips, right? 30 divided by 2 is 15. So roughly 15 pips would be somewhere about there. 12567. The stop loss would be somewhere here. Oops. 12567. Okay, and my profit target would be somewhere over there. So that will give me a 1:2 risk to return ratio. So again, let's see how this would play out. Now again, before you take the trade, always check on H1, right? So bear in mind, this line you see, that's the stop loss, this is the entry, and that's the profit target. And I'm going to draw a red arrow, or rather a red line here at my potential entry point. Next thing is I'm going to go to H1, and again this trade has already happened, so let's go back in retrospect and take a look, right? So you always want to make sure that at a H1 level, not only is it on a downtrend, but you also want to make sure on a H1 level, your stop loss that you want to place is above the moving average resistance on H1 as well. So what does it mean? Now notice that on H1, which I am right now at H1, where's the resistance? The resistance is here, boom, boom, right? So the resistance, it is at the blue line, the 18 EMA, right? You can see that the 18 has acted as a strong resistance. So my stop loss, which is over here, which I drew earlier on, is above this line as well. So I want to make sure that my stop loss is protected. Always place your stop loss above your moving average resistance on both time frames. That means on a 15 and on a H1, they must both be protected behind the moving average. The same thing for when you go long, right? Your stop loss should be below the moving average at the 50-minute candle and at the H1 candle. This is really, really critical. So if it is not, then don't take the trade. Don't take the trade, right? Okay, so once you've checked that, you go back to your 50-minute candles and say, okay, it's a valid trade. And of course, goes without mentioning that you want to see that the 50 has been tested before, right? The 50 has been tested to be a strong resistance. So you're confident that this time, when it goes to the 50, it should bounce. Again, there's no 100%, but most of the time it will bounce, right? Okay, so what you could have done is wait for the price to go up, and the moment the price goes up above the 50, what can you do? Yeah, immediately place your sell stop order over there. So if it comes back down, which it did, you would trigger the sell order. So the next candle, it goes down, then goes up again, constipates, and boom, it hits your profit target. There we go. So this is essentially how you trade the bounce setup. Now, you could have actually traded this as a TCE as well. Remember that for TCE, the trend continuation strategy, you wait for a trigger, and we'll talk about that in a short while. So in a bounce, you don't wait for any candlestick pattern. The moment you see it hit, you get in, and that's it. So what's the advantage of the bounce? The advantage is because you enter near the moving average or at the moving average, what happens? Yeah, your stop loss is usually relatively far away. So it's a bit hard to hit your stop loss. That's the safe thing about the bounce. All right, to hit your stop loss, it has to break through and to really change the trend. If it does not change the trend continues down, usually it will not hit the stop loss. All right, so that's the good thing about the bounce, the advantage. The risk of the bounce is that because we don't wait for a trigger or candlestick pattern, we are really having confidence that this moving average will hold when it hits. And that's why you're going to see that it has been tested before. That's really important. All right, now I'm going to talk about trading the bounce strategy on the H1 time frame. Recall in our original strategy, we are trading on the M15 time frame, and we are confirming with the H1 time frame. So now I'm going to talk about trading on the H1 time frame and confirming with the H4 time frame. Now, personally, I tend to be trading more on the H1 time frame myself now, for a very simple reason, because I've been pretty busy building my businesses and traveling. So H1 time frame is a lot slower, so it's a lot easier for me to catch a trade. But if I am around and I do see an M15 time frame, or if it's called out in the chat room, I will take it as well. Yeah, I do know some students recently have mentioned in the chat group that they've got very busy jobs, so they can't trade on M15, so they're trading on H1, and that's fine. You can be profitable on any time frame. In fact, today there was a gentleman who mentioned that he was trading on H4 time frame and the daily time frame, and he managed to achieve about 20 plus or even 30 R in 4 weeks using the bounce strategy, or I think it's a TCE strategy. Yeah. So the point is, you can trade it on any time frame that you want. The advantage of going on a higher time frame is that it is slower, so you're not so anxious to have to catch it at that moment, right? The only thing about a higher time frame is it takes longer to close the trade, and there's nothing wrong with it. Just be a bit patient. Okay, so let me talk about a bit of nuances about trading on the H1 time frame with the bounce strategy. Now, on the original M15, I only trade bounce when it's bouncing off the 50 moving average. If you recall, I do not trade when it bounces off the 18 EMA, only the 50. But for the H1 time frame, I trade it on both bouncing on the 18 EMA or bouncing off the 50 EMA. So that's one difference. Okay, so on the H1 time frame, you can trade it when it bounces off either the 50 or the 18 EMA. But again, it has to be tested recently, really important. The other difference is when I'm trading on H1, my stop loss distance is at least 20 to 30 pips compared to the 50-minute time frame where my stop loss is 8 pips minimum. Okay, so on H1 it's at least 20 to 30 pips. Usually for pound pairs, pound tends to be more volatile, and euro, especially at times, I will use 30 pips stop loss as well. Again, it doesn't have to be exactly 20 or 30. It could be like 25 or 30 or something like that, right? And I aim usually for 1.5R, all right? For M15, I aim for 2R. I risk 1 to make 2. On the H1 time frame, I tend to aim for 1 to 1.5. For a very simple reason that if 1R is 30 pips, 2R is 60 pips. And to reach 60 pips, it's going to take quite a long time to reach 60 pips. So I take 45 and I'm pretty happy with that. Next thing, the good thing about H1 and higher time frames is that the spread has less impact on the trade. When you trade on a 15-minute time frame or less, you have to trade with very tight spreads, like maximum 1 pip spread. Okay, and you have to use only certain brokers that can do that. But I know some of you in the US or in Canada, your brokers may have wider spreads of 2 or 3 pips. So in that case, I would suggest you trade on H1 or H4 time frame, because when you trade on a higher time frame and the stop loss is wider, like 20, 30, 40 pips, then the spread of 2 or 3 pips doesn't make much of a difference. All right, so that's another advantage. Next, for H1, do note that we verify with the H4 time frame. Right, so again, the H4 time frame must be aligned. And as usual, when you place a stop loss on H1, on H4, also ensure the stop loss is below the support when you're going long, and or above the resistance when you're going short at the H4 level. So again, stop losses must always be protected by a moving average on both time frames. All right, so let's take a look at a couple of bounce on H1 trades. Okay, so this is a H1 trade on pound dollar, and again you can see it's bouncing off the 50, bouncing off the 50, bouncing off the 50. Again, as long as it's tested once before I enter, that's fine. All right, but again you can see this tested once, twice, 3 times. So this shows it's a very strong 50 support. All right, so right now it's coming down, coming down, coming down, and I want to enter right at the 50 moving average. I'm convinced it will bounce because it's been tested before over here. Again, I can put a buy limit order, and where would I place the stop loss? Again, I'll measure the distance from my entry to the previous high. It's about 50 pips, right? So I've got 50 pips to take, but more conservative, I'll lower it slightly to 45. So I'm going to take profit at 45 pips, which means that my stop loss can be 30 pips if I'm aiming for 1:1.5. All right. The idea is to place your stop loss far enough so that it can't get hit easily. All right. Now remember that, let's imagine this is a moving average, right? This is the 50 moving average. In reality, the price doesn't always bounce exactly off the 50, right? Or off a support. Sometimes you must remember that it may go below that by a bit, okay? And then reverse back up again, right? And why this happens is because of market manipulation, right? So many people know that traders place their stop loss below the moving average, right below it. So what some of these institutional traders, banks and market makers, they sometimes purposely force the price down below the moving average to kind of like fake people out and trigger their stop loss. And once their stop loss is hit and they're forced to sell, these big buyers will then buy and then run the price up. So you want to put the stop loss far enough such that even if it goes down and hits other people's stop loss, yours doesn't get hit, and then it goes back up again. All right, so that's the whole idea. Put it far enough so it won't get hit, especially if there's no trigger and you're relying right on the 50. Okay, so again, notice in this case, my entry is over here, stop loss is here, profit target is here. What must we do? Once we have placed our lines on H1, so normally I'll just draw lines. The next thing I'll do is I'll look at H4 to ensure that H4 is aligned as well. So this is the H1, I'm now going to H4. Right, so verify that H4 is aligned and supported as well. So this is H4. You can see it's a clear uptrend. And notice on H4, where's the strong support? That's right, the strong support is now on the 18 EMA, this blue line. Can you see? Tested, tested. And my stop loss, which I placed on H1, you can see on H4 it is here. So the stop loss is below the 18 EMA. So I'm confident that my stop loss again is being protected by this, so that if it hits, you'll bounce back up. All right, so very important, stop loss must be protected behind a moving average on both time frames. Here's another example. Well, sorry, it's the same example. So what happened was exactly what I said. So notice the price went down and it did not exactly bounce at the 50. It went below there. Can you see that? So people who put their stop losses too close would have all their stop losses taken out here. But because we placed our stop loss 30 pips away far enough, we were not hit, and then it went on to TP. All right, so that's the good thing about the bounce setup. Stop loss far enough that it won't get hit easily. And other people's stop loss will get hit when ours are pretty safe over here. All right, so now let's do a quick review of the TCE strategy, trend continuation entry. So this is basically like the bounce, except we wait for a trigger. So in fact, I call this bounce version 2. So the rules are the same, all right? We can trade them on M15 candles or H1 candles or H4 candles, up to you. So right now I'm going to talk about it in the context of M15 time frame. So again, similarly, we need a very clear uptrend when we're going long. The price above 18, 18 above 50, above 200. And again, we need to see that higher high and higher low pattern, right? So take a look over here, right? So the price is coming down and it's going to hit the 50 moving average. And we want to ensure that the current swing high is higher than the previous swing high. And this bounce low is higher than the previous low over there. So higher high, higher low. So those rules remain the same. Next, we check the higher time frame. So on H1, we also want to see an uptrend. So the first two rules are the same. The third rule is also the same, where again, if it's going to be bouncing off the 50, ensure that it was tested recently before. If it's bouncing off the 18, it must have been tested recently before as well, right? So the current swing low is a reliable support, right? So it can be bouncing off either the 18 or the 50 moving average, okay? Now, the main difference for TCE is we don't enter right at the moving average. We wait for a bullish candlestick pattern to show that it is reversing. So we either wait for a bullish engulfing pattern, or we wait for a consolidation of 4 or more candles and for it to break out of the consolidation. Okay, so right at the moving average, if we see a bullish engulfing pattern, that is our trigger for the trade. Now again, some people have a few questions. Must the bullish engulfing come immediately the moment it touches that moving average? No, it doesn't have to. Sometimes the price can go to the moving average and it may form some other candles for a while, and then you get the bullish engulfing after a few candles. So it doesn't have to be immediately. All right. So the moment you see that bullish engulfing pattern, okay, what do? You place your buy stop order just above the high of the bullish candle, and your stop loss would be just below the low of the swing low of this pattern, right? The lowest point. So again, for M15, your stop loss distance should be at least 8 pips. And if you're trading on H1 time frame, it should be at least 20 pips, right? Just be careful. Sometimes if the bullish engulfing pattern is too big, like if you get a very big green candle, all right, sometimes you may have a very big green candle, like so. So in cases like that, what happens? In cases like that, if you place your buy order above the high of the candle and stop loss there, you may get a 1 hour distance that's a bit too big. So your stop loss becomes a bit too big, and so to hit 2 hour becomes very difficult. So in cases like this, what do I do? In these cases, instead of placing a buy stop order above the high of the candle, what I do is I wait for the next candle to exceed the high. Remember, we want the next candle to exceed the high of the bullish pattern, so we know that it's continuing. So the moment it exceeds the high, what do? I'll then place a buy limit order, at about 50% of the length of the candle, right? Which means that I want to wait for the price to hopefully come back and retrace back 50% of the length of this candle. And if it does, it will trigger my buy order, and I buy at a better price. I buy at a lower price so that my stop loss distance can be smaller. And then hopefully it will return all the way up there. So that could be another way of entering for the bullish engulfing. The next possible scenario is right at this point, you see the candles consolidating, going sideways like so, right? 4 or more candles going sideways. So the moment you see that, that's a consolidation. So we will put our buy order, can put a buy stop order, all right, about 1 pip above the high of the consolidation, and your stop loss 1 pip below the low of the consolidation. So again, the distance is 1 hour. So if the price moves out of the consolidation by 1 pip, it will trigger your buy order. All right, so that's the main difference for TCE. You wait for a trigger and you place your buy order above the high of that trigger. And you want the price to exceed the high of the trigger before it's valid. So what's the advantage of this approach? The advantage is you only enter when you see a candlestick reversal, right? The disadvantage is your stop loss tends to be closer compared to the bounce where it is further away. So there are pros and cons to both approaches. But I would say in the long run, they are both equally as profitable. All right, so I've already mentioned this, all right? Basically, place your buy order above the engulfing pattern or the consolidation. Place your stop loss below the current swing low. And, right, you can target 2 hour above the entry price. All right. Now, some people are asking this question, so if I'm entering over here, must my target price be below the current swing high? It's not a must. You can place your target price above the current swing high, because remember, if the uptrend continues, it should make higher highs and higher lows, right? So you can place your profit target above the current swing high to reach 2 hour if you want, but just place it slightly above the current swing high. But again, you will find trades where you can hit 2 hour within the current swing high, and those are the safest trades to take, right? Because if you can take profit before exceeding the current swing high, that is always safest. Again, ensure you enter before major news is released, and if you are already in, exit before the news is released. So for shorts, it's just the opposite. I'm not going to spend too much time on it. All right, basically it's just a reverse. All right. What I like to spend time on really is talking about, what constitutes a high probability TC setup? You know, what's a high probability? Because again, every day you will see many of these setups, many of them. And a common mistake traders make is that they go for quantity, right? So for me and for all the successful traders, it's not about quantity. It's not about the number of trades you take. It's the quality of trades. So you got to be very patient to wait for that perfect pitch. Like in baseball, you are a batter, right? Don't swing at every ball that comes your way. Wait for that perfect pitch before you swing. So I can tell you there are times when on certain days I look at many bounce or TC setups and I don't take them, right? Because they are not high quality. So always go for high quality. It is quality and not quantity. And never be impatient and trigger happy and never force a trade. Let the trade come to you. I find that when I'm chasing a trade, you know, I'm looking for a trade, I want to find a trade, you know, that's when I tend to take low quality trades and my trading performance suffers. But when I adopt an attitude where I say, oh, let the trade come to me, if it comes, it comes, it doesn't come, fine. When I have that kind of laid back attitude, I tend to do really, really well. It's kind of like chasing the opposite sex. The more you chase them, the more they run away, right? The more you hang back and be cool, the more they come to you. So let the trades come to you. Don't chase the trades and don't force a trade. Very, very important. Okay, so with that said, what's a high probability setup? First, I want to see the price retracing to the moving average. And very important, I want the moving average to have been recently tested before. And I've mentioned this many, many times. Whether it's a bounce or TC, it must be tested before. So again, as the price is coming down and it's going to hit this 50, has it been tested before? Yes, it must be tested before. If it's bouncing off the 18 must be tested before. Next, the price should retrace to a Fibonacci level of 50% or 61%. Now, this is a bonus. It is not a must. So I will take it even if it's not a Fibonacci level. Next, the price has not moved too far away from the current swing low. So sometimes by the time you see this bullish engulfing pattern, it may be a very big engulfing pattern. So by the time you enter here, what's happening? You're already entering near the high over there. So you don't have much meat left. You want to be able to enter and capture most of the meat before reaching the previous swing high. Or the recent swing high. Call it recent swing high. Okay, and I've mentioned this again many times. Very, very important. This is a must. I'm going to put a star over there. The stop loss that you want to place must be below a tested support level on M15 and on H1. And again, if you're trading on H1, it must be below a tested support on H4. And for short setups, the stop loss must be above a tested resistance. All right, so please print this out and burn it in your brain. Really, really important. Okay. So let's take a look at a few more examples so you really drill that in, right? Okay, so right now, what do I have? This is a TC setup. So I'm looking to enter here on the right. Okay, what's my trigger? My trigger is a bullish engulfing candle. Can you see this big green candle engulfs the red candle? So that's my bullish engulfing pattern. So it is bouncing off the 18 moving average. So has it been tested before? Yes, check, it's been tested before. Is it making a higher high and a higher low? Yes, check. Very, very important. So where do I place my buy order? I place it above the high of this candle. It could be 1 pip above. Stop loss, again, it could be just below the swing low or 1 pip below. And it must be at least 8 pips. Minimum 8 pips. So in this case, I'm aiming for, I have an 8 pip, I'm aiming for 16, for example. Or you can aim for 1.5, which is 13 pips. Right? So again, your profit target could be just below the recent swing high or could be just above that. It is fine. Okay. Now, what's more important is look at H1. So your stop loss is, you can see on M15, your stop loss is protected by this 50 moving average. Sorry, by this 18 moving average. On the higher time frame, is it also protected? Let's check. Okay, so you can see this is the stop loss and it is protected by the 6 EMA. Notice on the H1 time frame, right, this red line is a strong support. All right, there you go. And my stop loss is protected behind the support. That's what I'm talking about. It has to be protected. So on H1, my stop loss is below the 6 EMA support. That's a must. Another example, New Zealand dollar. Again, okay, so in this case, it's bouncing off the 18. Has it been tested before? Yes, multiple times. I'm convinced the 18 is strong. Does it make a higher high? Is it a higher low? Yes. I've got my uptrend wave pattern. Where do I put my entry price? There. This green line is my entry price. Stop loss is over there. That's my 1 hour. So again, on M15, my stop loss is below this support, this 18 support. I now have to check on H1, is it also below a support? Yes, it is. All right, so you can see on the H1 time frame, my stop loss, which is the red line, is below the support, because notice that this red line over here, and let me draw that red line, this is acting as a support on H1. So my stop loss is below that. So again, a high probability trade. Now let's look at one which is a low probability trade. So this is one that I did not take. Okay, why? So again, on the M15 time frame, it's bouncing off the 50 moving average. Can you see that? All right, has it been tested? This is not as good. That's number one. You want to see the price hit and get rejected. So this was not really a very good test. Well, this is an okay test. Now, it can break below and reverse back. It's okay, right? Now, my beef is not with the test. My beef is this. My entry is over there, stop loss is over there, my bullish engulfing pattern, right? Now, my problem with this trade is this. When I go on H1, what happens? Notice the stop loss is here. Can you see that? And the stop loss is not below a strong support. Why? Notice that on this H1 time frame, where's the strong support? Is it the 6 EMA, the red line, or is it the blue? Or is it the thick blue? Well, if you look at the recent price action, notice what happens. Boom, boom, boom. Notice the price tends to break below the 6 and the 18 and almost hit the 50. So if I put my stop loss here on the H1 time frame, I'm asking for trouble because I'm not convinced that this red or this blue is going to hold because it was broken easily over here. And sure enough, it was a losing trade. All right, it broke and touched the 50 and went all the way up. So your stop loss would have gotten hit because on H1, it was not a convincing support. All right, great. Now, for the next part of this webinar, what I did was, some of you recall, I posted on the chat group, I said, hey, those of you who have been doing reasonably well, I appreciate it if you can write to me directly and tell me about what advice you have for newbie traders. Because as you trade, different traders have different styles. And after a while, they find what works for them. And I find that instead of me telling you how I trade, I want you to hear from other traders as well. So, it's just not Adam, it's not only Adam who can do it. Everyone can do it. And these people who are doing it, a couple of them, when they started off, they were losing. They had losing streaks. They busted their account, but they didn't give up. They changed, they improved, they learned, and now they're doing really well. So I want to show you some of them who have written to me and given me permission to share their advice and some of their recent results. Okay, so the first is Jeff, Jeff Hu, and these were his recent results, which are pretty impressive. He started trading in October, and so he's got 3 months of trading so far. And for October, you see he got 18R, and he got 10R for November, and 12R for December. So total of 39R, which is pretty good. All right, here is a 60% win rate on average. All right. In fact, over here you can see some of his stats. In October, he had 13 wins and 9 losses. For October. November, he had 8 wins and 6 losses. December, 8 wins and 4 losses. All right. Now, everyone has their own unique styles of trading. Okay. This is summary of Jeff's style. So his preferred strategy is he focuses mainly on TCE. In fact, 90% of his trades are TCE, and he focuses on M15. Why? Well, he just likes it, right? And occasionally he will trade a bounce on the H1 time frame. To him, he says higher time frame alignment is critical, which I mentioned. And now he's got a unique style, all right, which is for Jeff. I noticed that for his trades, his target price is always below the previous swing high for longs, and above the previous swing low for shorts. And he always targets 2R. He always goes for 2R. So that's him, right? That's him. So in other words, for Jeff, if he's what he's saying is this. In fact, a couple of weeks ago, Jeff gave permission to post his journal online. So you can search back, you can download it, and you can look at actually all his trades one by one. And that's why I looked at it and I noticed that for Jeff, he ensures that when he buys here, for example, when he's going long, his profit target is always below this. He's always below the recent swing high. So he's always targeting, he never targets above that. That's his style. And he always wants to make sure that he can get 1:2 before hitting his profit target. And if he doesn't get 1:2, he won't take the trade. All right. So because of that, notice that he doesn't take that many trades. He only takes 12 to 20 trades a month. Right. In October, he only took 22 trades. November, he took 14. And December, he took 12 trades. So he doesn't even trade every day. So on certain days, you notice there are many trades, he doesn't take it because it doesn't give him 1:2. All right. So he's pretty selective with his trades. All right. And that's his style. All right. All right. This is his sharing. It says, hi, this is Jeff. I was once your student from Malaysia. Blah, 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 blah. What does it say? Yeah. I only take high probability trades like you taught. Hence, there's only a few trades taken so far. I've been consistently profitable for 3 months since the beginning and having a 60% win rate so far. Yeah. All right, so that's Jeff. Now let's look at Oystein. Oystein, as you know, has just recently become a full-time trader. Just quit his job. He's doing it full-time. So I wish him all the very best. Okay. And Oystein is also the person who has helped to develop a lot of the scanning software of the TCE dashboard and all that. So very grateful for him for his great contributions towards the community. All right, and he's had really consistent results. In fact, he just posted that he's been consistently profitable for I think about 1 year or 2 years, something like that, if I'm not wrong. So it's great, and this was his recent result that he did send over to me. All right, this was, I think, August, if I'm not wrong. Right, so 56% win rate. Yeah, and about 10.53 R for the month, right? And but it's not updated. His updated ones are also very profitable. But I like to share with you his sharing. And again, like the man who contributes a lot, he decided to write a very long advisory, which is great, right? So I'm going to read to you what he said, right? Okay, he said this. My first tip is to start focusing on only one strategy, which I agree with, right? I know from personal experience that it's very tempting to go into the market and employ all the strategies learned. So focus on one strategy, master it, and when you are consistent, add the next one, which I agree with him, right? Yeah, please do that. My main strategy is TCE. I also take range setups. These are my two core strategies. TC counts for 60%, range 30%, and bull flag 10%. I have a slight different approach to trade management. I enter 2 trades instead of 1. Right. So basically, what he does is, for example, he's risking 1% of his capital, for example, right? And from the position sizing, he's supposed to buy maybe 2 lots, for example. But instead of buying 2 lots at one go, he splits it into 2 trades. So one trade, he buys 1 lot, and another trade, he buys another 1 lot. So why does he split into 2 trades? Why does he do that? Because he has got 2 different profit targets. That's his own style, right? And there's nothing wrong, right? It works for him. So that I can take some profits at a specific ratio and run the second half of the trades for more profits if the trend continues. This approach gives me many small wins, but when I have that great trend, my biggest trade so far was 8R in one single trade, right? So if I'm not wrong, what he does is for half his trade, he takes profit at 2R or maybe 1.5R, right? You can clarify with him on the chat group. And for the other half, he doesn't have a profit target. He lets it run, and I think he watches it and puts a trailing stop loss, okay? For my stop loss, it's absolutely critical for me to use the ATR indicator, which actually is a good idea. The thing is, I don't use it because from experience, I gauge. But again, if you're not as experienced, you can look at ATR as well. So I use the ATR indicator to determine what's my minimum stop loss for this trade. So for Einstein, what he does is he always takes a stop loss of 1.5 times the ATR. ATR means the average true range. So you look at the ATR and multiply by 1.5, and that's his stop loss. If this amount is less than 8 pips, I will always take 8 pips minimum. All right, okay. I also make sure that my stop loss is always covered by a moving average, support or resistance, right? So that's what I mentioned, right? Another personal tip is to be very, very picky. There are lots of opportunities, but wait, the best setups are more rare, but it's absolutely worth the wait. Support resistant areas aligns with key support and resistance levels. These levels I usually draw from the H1 time frame, and they are both diagonal trend lines and horizontal zones. I look for at least 3 other correlating pairs going in the same direction. That means I want to see 3 other related pairs to have the same trend as my trade. If you want to find out more about correlation, it is in the videos, all right? It is in the level 1 Forex course videos under correlation. So I have got a video on that. Do watch it. Now at this point, maybe let me show you what he mentioned on ATR, for those of you who don't know what ATR means. So go to Insert, Indicator, and go to that. This one. This is Average True Range, right? Click on that. And by default, it is 14 periods. So just keep 14. I'm gonna put it black, easier to see. Boom, all right, there we go. So this is the ATR, right? This is the ATR. So you can see the ATR keeps changing, right? So find out the current. So what he does, he finds out if he wants to put a trade now, he checks the current ATR, all right, and he multiplies it by 1.5. So that's what he does. Let me see if I can show you how it's done. Let me get my magnifying capabilities going. Zoom. Okay. So you need to get your crosshair and put it there to see what's the value. Now I'm going to zoom in using my zoom. There you go. Okay. So what does it say? 0016, 0.0016. So that is 16 pips. There you go. All right. So right now for this particular pair, what's the ATR? 16 pips. So for Einstein, he'll take 16 multiplied by 1.5. What's that? That's 16 times 1.5. So he makes sure that the stop loss is at least 24 pips. So that's what he does. I mean, there's nothing wrong. You can do that as well, right? It's a more scientific way of doing it. All right. Now, the other thing that Einstein has done, he's actually created a checklist for himself, where every time before he trades, he takes the checklist and he says, okay, it must meet all my criteria before I take the trade. So he's got this checklist that he pastes right in front of him. All right, so that's the checklist over there. Okay. So you can pause the video and you can kind of like take a picture of it if you want. All right. So this is for TC and bounce, and for trading the range, he has a checklist as well that he must, check all the boxes, before he'll take the trade. Right. So very useful sharing. Thank you very much for sharing this. Okay. Let me now share another one from CK Ong. And he's got a pretty interesting story. He says, I did well for my first 4 months and achieved 100% return on my investment. However, subsequently, the outcome turned bad. The main reason was I over-traded, right? He got overconfident and started, taking lousy, low-quality trades. So what happened? I took many low-property trades, thinking since the outcome is random, there's no harm in taking them. However, it pulled down my winning rate significantly. When I had positive profit from the trades during the day, I would have the thinking of just take one more to gain more during the night. Oops. Most of them, I just picked up low property trades and ended up with losing trades, and this reduced my net gains for the day. When I had negative profit from the trades during the day, I had the thinking that I must recover what I lost. Right? This is very typical. I lost money, I got to get it back. So you take a low quality trades just to make back the money, and most of them, again, pick low quality trades and suffered even more losing trades, right? Very, very good lesson. And it says, this month, I started my new account with Pepperstone and decided to start from fresh. I disciplined myself to take only high property trades, to wait for such a trade to come to me instead of forcing myself to take a trade. That's what I said. This month, I only focused on TC and took only 13 trades for the month. The win rate was 70% with a return of 14.2R. Right? That's pretty good. 14R. So again, take 13 trades and get 14R. Better than taking 30 trades and making 5R. Okay? I also learned how to control my emotion. Do not get excited when someone in the chat group alerted a possible trade. When others took the trade, it does not mean I must follow it. Very good. Even if they ended up with a winning trade eventually, I would feel that it's not wasted. I will not regret it, as I did my own analysis and decided to skip it because it's not a high probability trade. If I miss a good trade, I'll just tell myself that there'll be another good trade coming to be and I move on. I like this one. I would turn off the chat group notification if I decided not to take any more trades during the day, especially in the night. Okay, all right, cool. And this was his result in December. All right, after starting afresh. So he had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. He had 13 trades. He had 1, 2, 3, 4 losing trades. Okay, and 1, 2, 3, 4, 5, 6, 7, 8, 9 winning trades. So pretty good, right? So great lessons from some of our students over here. All right, so that concludes this Forex coaching webinar for January. I hope you enjoyed it. If you have got questions to me or any of the other traders who shared, please post them on the chat group, and we look forward to answering your questions, and continue to actively be part of the community. And I wish you all the success and I'll see you guys soon.